So good afternoon, everyone. Today, me along with Shuvam Tripathy will be discussing about recent trends in bank risk management. So coming to introduction, banks in the process of financial intermediation are confronted by various kinds of risks which are financially and non-financial related, and these risks are highly independent in nature and can affect one area of risk can affect and have various ramifications on various risk categories. Thus, the top level management of the banks should consider and give importance to each kind of risk and identify, measure, monitor, and control the overall level of the risk which are taken by the banks. So now let's look into various kinds of risks which are faced by banks. The first one is credit risk or default risk. So this risk is due to inability or unwillingness of a customer or a counterparty to meet his commitments in the relation to lending, trading, hedging, settlement, and other financial transaction. This is simply can be termed as a default risk. So when a customer fails to repay his loan, his or her loan to the bank, then it is treated as a credit risk. So we have, for example, if you have seen in the recent times, so there are many NPAs have been increased for the banks. This can be termed as a credit risk for them. So, and these NPAs have reduced the financial stability of banks, thus uh, made all these debts led to financial instability of banks. And this credit risk of a bank portfolio depends on both external and internal factors. External factors can be of related to economy. So regarding the foreign exchange rates, interest rates, trade restrictions, economic sanctions, government policies, and etc. Internal factors can be uh, absence of prudential credit concentration limits, inadequately defining lending limits for loan officers and credit committees, deficiencies in approval of borrowers' financial positions, and excessive dependence of collaterals and inadequate risk pricing, and absence of loan review mechanism and post-sanction surveillance can lead to credit risk. And for this credit risk, we can have some monetary policies like credit approving authority. So each bank can have a formulated a scheme and delegation of powers for the committees for sanction of these loans. And next one, we can set a prudential limit for each kind of loans that a customer is willing to take. And we can see a loan review mechanism. We can check with the businesses, and we can also take collaterals in case of high business loan. That can be done. And the next risk is market risk. So traditionally credit risk is one of the primary challenge for banks. And next is the market risk, with the progressive deregulation of markets arising from adverse change in market variables such as interest rates, foreign exchange, and equity pricing, commodity pricing. So even a small change in market shows a huge impact in the banks. So uh, to monitor this market risk, so banks have a committee called ALCO, that is Liability Management Committee. So this committee focuses on the assets and liability sides of the bank, so maintain a stability between the balance sheet. And banks can also appoint an independent middle officer to track the magnitude of market on a real-time basis and gets to know the trends in the market. And the next risk is operational risk. So operational risk is the risk due to errors, interruptions, or damages caused by humans or in the processes or the systems. So this kind of operation risk is low in for simple bank operations, business operations such as retail banking and asset management, and higher in say in kind of sales and trading. So losses that occur due to human interruptions are including internal frauds or mistakes during the transaction. On a larger scale, fraud can occur through breaching of bank cybersecurity. It allows hackers to access the information of the customers which are stored in the servers. So this leads to bank's reputation and loss of trust within the customers. So this is a operational risk management strategy for banks. So for in this first step, bank will evaluate the risk profile that every level of an employee is being faced, and next they'll be monitoring they'll frame some key risk indicators, and they test the real-time operation controls, and they test with the controls and risk metrics, and provide visibility into determinants of risk levels such as spikes. And organization leaders can use these risk indicators to identify and categorize risk, and so that they can develop a mitigation strategy. And next one is their employee training. So training can be given to employees on how to save data. I mean, how to do operate with data storage and everything. And regarding the effectiveness of operation risk management, employees should be trained regarding the operations done by the bank for storing of the data of the customers. And next one is risk due to digitalization of bank operations. So as digitalization is getting deep into embedded into business banking strategy, so various BFSA players are increasing their channels of services into internet banking, mobile banking, and various NFC enabled cards, etc. So the more a banking is more into the digitalization, so it is more prone to risk. So while digitalization offers significant advantage like better customer experience, speed, efficiency, so BFSA firms also need to investigate the digital risk like payment fraud, cybersecurity breaches, regulatory and compliance issues on high priority. So next one is risk due to digitalization. So as social distancing is bringing a new behavioral change in customers and business, it is ensuring that payment ecosystem supported by banks, business and intermediaries is rapidly shifting into digital payments and digital platforms. So accompanying this shift, plethora of risk regarding the technology, cybersecurity, outsourcing, operational, regulatory, and legal. These financial institutions must address if they're able to continuing delivering the safest experience to their customers. To ensure customer satisfaction, so these financial institutions are outsourcing all part of their digital strategy to the third parties. So though they are giving this sort of operations to the third parties, the ultimate responsibility of the customer's data shall lie with the banking or the BFSI agents. Since, however, the underlying financial institutions must remain ultimately responsible for financial activities, whether they are performed within their organization or through an external organization. Therefore, financial institutions must ensure that supervisory considerations for the outsourcing of services are fulfilled through verification of vendor compliance with IT, cybersecurity, data governance, and other. So the mitigation measures for this kind of digitalization risk can be using artificial intelligence and machine learning for fraud protection. So fraud detection example can be of machine learning machine learning algorithms are used in credit card fraud detection. Banks are generally equipped with these monitoring systems and are trained on historical payment data. So algorithm training, validation, backtesting are based on various data sets of credit card transaction data. ML powered classification algorithms can easily label events as fraud versus non-fraud to stop fraud transactions in real time. And ML machine learning algorithms can also be used to enhance network security significantly. So data scientists are always trying on various training systems to detect flags such as money laundering and etc. So emerging risks in the recent years will be discussed by Shuvam.
Thank you, Chandra, for giving a brief overview of the various risks that bank face in its day-to-day operation. And in order to mitigate such risk, a lot of reforms and regulation have taken place on a timely manner, like the Basel norms for having a smooth ongoing banking operation. But beside this traditional risk, a bank have faced very certain risks which are trending in these recent years and which have hampered the banking and financial industry drastically. So starting with the model risk, like any other business, the banking business also depend upon the business model. Like the banking industry also follows a model for its product and services. Hence, it is important to understand the business model better, else the model can turn very unfavorable from a business point of view. Like which we can also be, it can be traced from the US global financial crisis of 2008, where the banks developed a model for lending real estate loan. But as soon as the real estate demand falls in the US, the situation led to a serious systemic risk affecting the whole global economy. For that, the banks or the financial institution can develop a MRM dashboard or a MRM tool, which can help to identify the various risks and the various decisions which have taken due to misuse models. And these MRM tools can employ various techniques or practices that will identify and mitigate such risk. And financial institutions like bank and insurance companies highly depend upon the credit behavioral and market model. Coming with the cybersecurity risk. During the recent years, cyber attacks have been increasing on the financial institution heavily. As banks store an increasing amount of data about their customers, so it is necessary for the bank to make a protection measures against the cyber attacks as a priority. As we know that like all the operations of banks are uh, are happening on a digital platform. So there is a serious need for maintaining the cybersecurity protection on a priority basis. So for the measures like in as per the Basel Committee's concern, various principles are in place to deal with operational issues related to information and communication, including cybersecurity risk. Example, such principles, one of the example of such principle is like the principles for operational resilience is in place for mitigating such type of cybersecurity risk. And it is also important for banks to adopt new tools and good practices and framework, including provisions for testing their accuracy and loopholes. Like the various frameworks or the tools must be designed so that it equipped and aligned with the industry standards, which includes various standards set by the NIST, which is National Institute of Standards and Technology, and other cybersecurity frameworks designed by the ISO 27001 and other. Now, risk related to ESG, as we all know that ESG is the need of the hour, and there are a lot of aspects with the ESG factor. So, like there are various elements of ESG where there is environment, social, and governance. Coming to the banking sector, contribution towards the social and governance part of the ESG, like the banks have introduced gender diversity, equal pay in their working environment and working culture. But when it comes to the E factor of the ESG, which is the environmental, the banking sector also are emphasizing on green financing, green portfolios in order to make their sustainable reporting on a better way. Uh, so, to deliver the risk management function, there is a need to have a proper organizational structure to perform the function and activities pertaining to various risks. So, here is a model of an organizational structure as advised by the RBI. So, this is just a suggested organizational structure model. So here we can see like a organizational structure can be made where which will be headed by the board of directors, and it can be the function can be sub divided into risk management committee, and it is can be further segregated into various committee related to various factor of risk like credit risk management, market risk management committee, and operational risk management committee also. So this one is then risk management committee function like one of the organizational structure which we have extracted from the SBI annual report. So like this one is their organizational structure which SBI follow in order to deliver the risk management function, where we can see that the board of directors have delegated one risk management committee board, which is which is a dedicated committee which is looking for the various risk related to asset liability management committee. Then there are other committee also related to credit risk, market risk, operational risk, then enterprise and group risk management committee, and also compliance risk management committee. And further various designations has also been created in order to look after such matters of risk. Thank you.